efficient trade management in low IV environments. Efficient trade management in low IV environments. Okay, let's go to the next slide. See what the team's looking for here. So the graph below shows the link between historical volatility, which is the annualized standard deviation of price returns, and implied volatility, which is the predicted stock market volatility. Throughout the current year, this year, both values have exhibited a consistent reduction in comparison with the preceding year, which recorded a peak value of approximately 25 thus far. All that means is that last year we were heavy. This market was down most of the year, and this year is completely opposite. The market's been pretty much up most of the year. This month, last month, August, was our first down month of the year. So in addition to trading in low IV significantly carries significantly more outlier risk compared to trading in high IV. And we talk about that all the time. But again, this is not an everyday thing. When you're trading in low IV, yes, you have a lot of outlier risk, but it doesn't happen very often.
Right.
Let's go to the next slide. So despite usually having lower probability of profit and potential gains compared to trades with undefined risk, defined risk trades do provide a safeguard against significant losses. So the question then comes up, in low IV environments, are you going to do more defined risk trades than you would have? In high IV, you're not going to do that many defined risk trades. But in low IV, should you do more defined risk trades? Therefore, defining risk when faced with low IV situations presents a strategy for mitigating the impact of outlier losses while maximizing the advantages of short premium. So what insights can be gained from examining the performance in low IV volatility environments by using strategies like a strangle versus an iron condor? And how do different metrics play a role in this analysis? We're going to dig into the weeds right here. Let's go to the next slide. So again, we've been expanding the depth of our database. We're up to 19 years right now. Last couple of months, you've seen us go pretty much from 2004 to 2023. We've cleaned everything up now. It looks pretty good from internally looking at our database. 45 days managed to 21 days, 16 Delta Strangle, 10-16 Iron Condor. And then we computed, everything from C-bar to probability of profit to daily P&L, everything. Okay, let's go next slide. Okay, so here we start getting into something, and you're going to see these are going to be like very subtle differences, and this is VIX below 25, so this is where we are like most of the time. So this Strangle strategy experiences a large loss that's approximately 7 times greater than its large profit, whereas the Iron Condor strategy sees its largest loss about 5 times greater than its largest profit. Now, right on the surface, I would say that doesn't seem bad at all for a strangle.
No, it doesn't.
Because if the strangle's loss is only 7 times greater, but the Iron Condor's loss is 5 times greater, then why even waste your time with a defined risk trade? Moreover, despite both strategies having a relatively similar pop, the maximum loss observed in the Iron Condor approach is roughly 47% lower than that of strangle. Okay, well, that's your argument for your Iron Condor. It's not that your largest loss is that much better than the naked position. It's really all about the fact that, okay, your Iron Condor is roughly 47% lower compared to the strangle. That's your max loss. So when you start to look at that, then you're like, okay, see, the pop is virtually the same. The pop's the same. The strangle and the white Iron Condor, they both actually make pretty good money. The white Iron Condor loses less money and it's worse loss. That's about it. That's under 25 though. Let's go to the next slide. And by the way, IV is almost always under 25. So this table demonstrates that in both strategies, the average top 5% profit is roughly half of the 5 worst percent profit calculated using CVAR. So in low implied volatility environment, iron condors on average yield 28% lower profits compared to strangles. However, they exhibit 48% less risk. All right, Bat, how do you take that information? So if you have an iron condor, a wide iron condor, you make 28% less. So you can see the final P&L there is $9 versus $12. That's your 28 or 30%. But your CVAR is almost double. See it, 800 versus 400?
Yeah, your CVAR, that's your value of risk on the strangle is double what the white iron condor is. That was what our friend was talking about on the call yesterday, I believe. Pointing out that risk of the strangle.
When I look at all these statistics, to me, it doesn't get me to necessarily think that in
love one over the other, or one's any much better than the other, any
it
worse.
It doesn't get me to think that one is that much better than the other, or that it makes that big a difference. What it does tell me is that when IV is low, you can't do much in low IVR. When IV is low, you can do stuff. When you have low IV and low IVR, you can't do much. You just have to be careful. Like, I mean, we can break down the numbers and talk about, saving 48% risk, whatever it is, but that's just a reduction in your overall risk on your worst trades. It's I don't know. It doesn't seem like it seems like I got to be really careful in low IV. Let's go to the next slide. So in this context, the CVAR divided by the P&L per day provides insight to how much potential risk, as quantified by CVAR, is associated with each unit of profit and loss made each day. And by strangle, you can risk approximately 34% in each unit per day of P&L more using an iron condor than a strangle as a strategy. So that is actually interesting, that you can risk more to basically have the same kind of, you could take a third more risk to have essentially the same amount of overall risk in a defined risk trade. I'm not sure how you apply that.
Yeah, I don't know either.
Yeah, I'm not sure. Yeah, I'm looking at the ratio on the bottom of CVAR divided by P&L, and you know what? I'm not sure how you put that into I'm not sure how you make that actionable. But I think that the real takeaway from this segment is that when the VIX is below 25 and the IVR is cheap in the single digits or 10, 15, whatever, you don't want to trade the risk reward of trading strangles or wide iron condors. Neither one is that good.
Yeah, right.
And you either want to do something else or get creative and wait. Like we're still finding plenty of trades.
Of course, find them every day.
Yeah.
Haven't found any I've loved, but I've found a lot that have worked.
Yeah. Let's go next slide.
Apple up $1.40, Tesla down almost $6. You got a tug of war going on.
Yeah, Tesla and NVIDIA are keeping the cap on the NASDAQ today.
At bay.
Short premium strategies are still relatively profitable in low IV, but they tend to have lower average P&Ls and larger outlier losses. One strategy to handle outlier loss exposure and make the most benefits of short premium trades during defined risk times of low implied volatility. So in low IV, compared to 16 Delta Strangles, iron condors have an average P&L that is roughly 28% lower. And I guess this is your money shot here. So iron condors have 28% less P&L, approximately the same pop, but they're 48% less risky. They're 47% less in the 5 worst outcomes, the 5 worst percentage, 5% of the worst outcomes. and 38% less in the 5 best outcomes, and 47% lower maximum loss. So the team's making the case here that in really low IV, if you want to use a white iron condor, there's not that much difference between a white iron condor and a strangle.
And you'll save a little bit of buying power in the process.
Yes, but you won't make a lot of money either way.
Very good, sir. We'll take a quick 90-second break and come back. We got Mr. Scott Sheridan from Tasty Trade World Headquarters. That same Mr. Scott Sheridan who's now on X, formerly known as Twitter, at Scotty Sheridan TT.
Hold on, can I say, I got to say one thing before you hang up. When you search futures, because I searched futures on Tasty this morning, when you search futures, there's going to be one future that pops up with a 97% IVR that a lot of people ask me about, and it's this /SR3.
SR3, yeah, 3 month.
It's the 3 month. It's the
interest rate.
It's the replacement for the Eurodollar. It's the 3 month interest rate, and it has like, what's the IV rank? It's like 98, right?
95 and change. Yeah.
Okay, so don't trade it.
Yeah, no, I get it. It's got a volatility of 1.
Yeah, I get a lot of questions from customers all over about this particular product, just because when they scan, it pops up as the highest IVR.
Sure.
Don't trade it. It's a little bit. It's not a retail product, and you can't make any money trading the options in there.
Well, something that is a retail product is the Tasty Trade platform, and you can follow at Scott Sheridan TT on that X platform formerly known as Twitter. We'll be back in 90 seconds with Mr. Scott Sheridan next. Maybe he can tell you more about the features on the platform. If you've got a question, give us a buzz, 855-238-2789 or 855-BE-TASTY. Be back in 90 seconds.